Our global economies have proven mostly resilient as countries try to navigate this period of tariff limbo, but the shockwaves are clearly evident in growth forecasts being revised downwards. And the International Monetary Fund has recently slashed its forecast for global growth amid rising trade uncertainty. And in Citi's latest report, the bank sees global growth at 2.3% this year, down from 2.8% last year, with development market economies hit particularly hard. But there's been a de-escalation in trade tensions recently. The US and the European Union have agreed to speed up trade talks, and the US and China have announced a 90-day tariff reprieve. Despite the rollbacks, though, economists say the global fallout could still be significant. And for more, we are joined by Nathan Sheets. He is Global Chief Economist, Citi Research, and he once served as Undersecretary for the International Affairs at the US Department of Treasury. So, Nathan, thanks for joining us. We're really glad that you could make the time. I just want to start off on Citi's recent report that flagged that the global economy has so far absorbed tariff uncertainties, with the pace of activity slowing by just a notch. And so really what's been cushioning that blow, and why you believe this is just the calm before the storm?
Well, we have seen some notable resilience in the global economy through the first half of the year. And I think that the key insight and key driver there is that the principal channel through which the tariffs are likely to drag down growth outside of the United States is through reduced U.S. imports, that those tariffs make U.S. imports more expensive. And so the rest of the world isn't able to export as much, and that results in slower growth. But so far, the tariffs have not yet fully hit. And what's been happening in the United States is you've seen a significant front loading of spending by consumers, by firms, as they've taken investments and also sought to accumulate inventory. So then as we move into the second half of the year, we think all of that front loading that happened in the first half is going to need to be paid back. And we are likely to see a significant slowdown in U.S. imports and in foreign exports. And at that point, we are very, very likely to see significantly softer global economic performance. So we think this is the calm before the storm. And for global growth, things are likely to look a lot weaker in the second half of this year.
Yeah, and we've seen, the Fed holding rates steady, but they have, of course, as well flagged the rising economic uncertainty. How do you interpret the Fed's current stance? And is there perhaps some merit then to U.S. President Donald Trump's calls to lower rates?
For Jay Powell and his colleagues at the Federal Reserve, these tariffs are an absolute nightmare. They're a challenge. In economic speak, we describe them as a stagflationary shock, putting upward pressure on prices and inflation, putting downward pressure on growth. And what's the Fed to do? Should the Fed cut to support the economy, or should the Fed hike to fight inflation? The upshot is that Jay Powell has to be patient, wait and see how things play through. And that's what he's signaling now. And I expect that that's where he's likely to be, at least through the summer and into the fall. By the end of the year, I think the growth effects in the U.S. will be more severe. That will open the door for Fed rate cuts. But for now, it's patience, it's wait and see, it's meeting to meeting.
Right. I just want to look at some points that you guys have shared with us as well. And you say that the fiscal framework being considered by the White House would result in U.S. deficits remaining high over the coming decade, averaging 6% of GDP or higher. So what are the implications then for inflation, monetary policy ahead, as well as bond markets?
I see in the near term the tariffs being the biggest challenge, but over the medium to long run, it's definitely the U.S. fiscal position, as you've outlined. We have very high debt levels, and the U.S. deficit, under essentially any plausible scenario, is likely to be running in the 6 to 6.5% of GDP range, at least through the coming decade. We really don't have the political will in the United States to address these challenges. And I think the upshot, what does it mean? I think it's likely to mean higher bond yields in the United States. I think investors are likely to require an additional premium to hold U.S. debt. Could that also, over time, mean higher inflation, weaker growth? Those are risks for the economy. They're not necessarily yet in my baseline, but the outlook for the economy as a result of this fiscal is challenging.
Yeah, I think the recently passed tax and spending bills expected to add about $3.8 trillion to U.S. debt. What are the immediate macroeconomic risks that of increased borrowing from your experience at the Treasury? I mean, have you ever seen this sort of fiscal expansion, and really what message does it send to global investors?
I think this sort of fiscal expansion during a period when the economy is performing reasonably well is largely unprecedented in the United States, or in recent years, at least, in major advanced economies. But I do think we have some precedent for it in announced plans, and what we saw with Liz Truss and the UK. During the fall of 2022 and the gilt crisis, the sterling crisis, where she announced a fiscal program that was very stimulative. And the markets choked on that announcement. I don't know if that's where the United States is heading, but to me, that is the recent antecedent, an example of this kind of policy. And the markets did not receive it well.
Yeah. You've also described those tariffs under the Trump administration, as slated to be the most aggressive in decades. How do you think this marks a structural change in U.S. trade policy? And is this something future administrations might continue?
This is a very important set of issues, that this hostility, if you will, toward global trade and concerns about what trade means for the U.S. economy is very much a characteristic of Donald Trump's policies. But it is shared by many in the U.S. political system on both the right and left. Bernie Sanders, for example, has been equally categorical in his criticisms of trade. So I think what you're seeing here from the Trump administration really does highlight some deeper concerns amongst U.S. voters about the effects that trade has had. And specifically, I think that in the United States and probably globally, we need to think harder about how do we equitably distribute the gains from trade and the gains from global integration. I think that global integration has led to a more efficient global economy over the last 30 years, but there have been unintended consequences in terms of inequality that have not been adequately addressed. And I think we're seeing voters in the United States and arguably in other countries as well hit a pause button on it for that reason.
All right, Nathan, many thanks for taking the time to talk to us. Nathan Sheets there, Global Chief Economist at Citi Research.